Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. If you've ever dreamed of turning your pennies into prosperity, your nickels into fortunes, and your dollars into wealth, then today's video is just for you. We will talk about the secret to getting rich with SCHD. And no, it doesn't involve a magic lamp, a lottery ticket, or sending cash to a distant relative. So let's crack the code on how to get rich smartly with some help from SCHD and to unlock the vault to financial success. Recently, there has been a lot of talk about the underperformance of SCHD, how it lags the broader market, and has left people feeling concerned, and if SCHD still remains a valid investment option for the long term. Well, I think SCHD is poised for greatness. So let's talk about what SCHD is, what SCHD isn't, and then of course, how to get rich with SCHD. As a fund geared toward tracking the Dow Jones US Dividend 100 Index, SCHD is primarily used to give exposure to blue-chip dividend-paying companies that could continue to pay dividends for years to come. It has a strong track record of dividend growth since the ETF's inception in 2011 and is widely regarded as the king of dividend ETFs. To be included in the Dow Jones US Dividend 100 Index, the stock must pass through a series of screenings, which include at least 10 consecutive years of dividend payments, at least $500 million market cap, at least 3 months of average daily trade value of $2 million, and not an REIT. The market cap and average daily trade values ensure low-quality companies are filtered out. Stocks passing all screens are ranked by their dividend yield from top to bottom. The top half of securities based on this ranking are included for further stock selection process. For the next step, all eligible stocks are ranked based on 4 fundamental characters: free cash flow to debt, return to equity, dividend yield, and 5-year dividend growth rate. The 4 rankings are equally weighted to create a composite score for each stock. After that, the top 100 top-ranked stocks by the composite score are included in the index. There is no single company that makes up more than 5% of the index, so it's a great way to get dividend stocks and stay diversified. Over the years, SCHD has been consistently growing dividend payments, averaging double digits dividend growth each year. However, SCHD's dividend growth seems to hit a roadblock in 2023 as the trailing 12-month growth rate not only fell below 10%, but also fell behind its competitors. On top of that, the capital appreciation of SCHD adds even more uncertainty or anxiety among dividend investors, as the ETF price has lagged behind the overall market by a large margin. As we discussed in a prior video, the market rally in 2023 is mainly driven by companies in the tech sector. SCHD's top allocations are in industrials, healthcare, and financials, and only 12% of capital is geared towards the tech sector. In comparison, SPY Index has 27% of allocation in the tech sector. This less reliance on the tech industry makes SCHD's return lackluster compared to AI stocks such as Nvidia or Microsoft. But keep in mind that the balanced allocation is what made SCHD stand out in the past decade to grow its dividend payment year over year. I totally get it that investors don't want to miss out on huge rallies like we have seen so far, but investing in SCHD is all about the long term. As long as the dividends are coming and growing, we should stay calm and stay course. The secret of getting rich with SCHD is to hold on to it for a long time and not get distracted along the way. Another factor that makes dividend stocks less popular this year is that you can get a much higher yield and much lower risk elsewhere thanks to the Fed's aggressive interest rate hikes. There are high-yield savings accounts that pay around 5% APY for your deposit. We went over a few of those in a prior video. There are also money market funds with a 7-day SEC yield of 5% as well. Currently, this is what people flock to. Why risk your money with the stock market when you can get a guaranteed 5% return from your bank with no risk and an increasing interest rate environment? So, dividend stocks aren't going to do as well because people prefer to put their money in a high savings account or money market or the treasury. But this is the secret to SCHD. When the fund isn't performing well, it's the ideal time to buy. While interest rates from banks are attractive, eventually the Fed will cut those interest rates. So all that money you've been saving will find its way back into dividend stocks. By then, stock prices could be higher than today, so you may end up with fewer shares in your account after all. The stock selection process of SCHD ensures that only high-quality, high-value stocks are included in the ETF. That means even though stocks may be sluggish in the short term, these companies in SCHD provide excellent goods and services, and therefore will be profitable in the long run and will pay dividends to shareholders in the long run. Looking at the top holdings within SCHD, do you think that just because the share price hasn't done well year to date, that it will have an impact on the day-to-day activities of these companies? Well, those companies are all giants in their own industries. They have a long track record and have weathered many economic cycles of ups and downs. Based on their past performance, I think those companies will continue to optimize their operations or to seize new opportunities such that in the long run, they will see their stock price appreciate in value and they will keep paying or raising dividends throughout the years. SCHD is regarded as the king of dividend ETF, but it doesn't mean SCHD has to always go up. It's not designed to beat the market. Because if you are a long-term investor looking to live off dividends generated from SCHD, now is a good time to invest. Because essentially, with SCHD, you are buying at the low price. Or you can DCA SCHD over time. And either way, just remember that time in the market beats timing in the market. Building wealth is a marathon, not a sprint. So stay curious, keep learning, and don't be afraid to take calculated risks. So, if you enjoyed this video, please give it a thumbs up and consider subscribing for more. Don't forget to share your thoughts in the comments, and don't forget to turn on notifications for our latest content. Well, that's all for now. Thanks so much for watching, and we'll see you all in the next video.